Oh. Well, hi gang, as I always say in the Muni video that we do every week at Bloomberg. I see you're all vibrant and happy to be here this morning because we are the first panel, and I warned people about this, we get to steal all the good topics and everyone else's thunder. So, I have a couple of questions before I introduce my wonderful panel here, this magnificent gathering of brains, beauty, and talent. People ask me, various reporters and the producers and radio and TV, and they say, Joe, what can I ask? What's an interesting topic these days? I don't know. And I was just sitting there and I was looking around the room and I came up with 4 questions. I doubt we'll cover any of these though. But one was the muni industry, is it shrinking or growing? And when I look out in the room, I see an awful lot of gray heads. Then another one I thought about today, Mayor Emanuel. Is he going to be known as the mayor who lost Chicago? Then I thought, wow, is the world of public finance so shot through with conflicts of interest that reasonable conclusions are discouraged? And finally, does the language of muni analysis conceal more than reveal? So any of you who are looking for topics, I give those to you, and you could use them as you will. This, of course, we have the final question here. The big question is, are munis rich or cheap? And our panel today will consider that question and perhaps several of my others. And let me just run down this wonderful group. We have, of course, as David mentioned, John Mousseau, who's with Cumberland Advisors and works with David and one of the co-authors. Mary Francoeur of Assured Guarantee. We have Sean Carney, who's with BlackRock, and Kathleen McNamara, who's with UBS. Kathleen, I just want to, I came across your report that you sent out the other day, and I thought there was a marvelous statement at the end of your piece, one of your sections, and it said, we expect there to be considerable price volatility ahead and cannot rule out the possibility of an involuntary debt restructuring despite the political fallout from such a policy. And I thought, wow, that's something, but we could get to that as we go along. Mm-hmm. Now, since I am the moderator, I can say who goes first. So why don't we have Mary Francoeur? Why don't you begin? Why don't you kick off the conversation?
Oh, great. Okay, well, that's good because I'll start off the discussion with the idea that I'm a bond insurance credit analyst. And so for me to answer the question, are munis rich or cheap, I'm really not the right person to answer the question. But actually, I have a lot of questions, which is what I will sort of bring up during the course of the discussion. So what's the first thing that someone like me does when you're on a panel talking about whether or not munis are rich or cheap? Well, you Google the question, are munis rich or cheap? And so I wound up going through a bunch of literature, and one of the more interesting things that I kind of came across was a discussion of the impact of the cycles of the bond insurance industry on the municipal market, and that's actually what I want to talk about over the next couple of minutes. So, Assured Guarantee, quick infomercial, is the leading provider of financial guarantees. We basically guarantee the full and timely payment of the bonds that we insure. Most of them are municipal bonds. Just to take a look at this chart here, this is a chart over the recent cycle since 2013 about the penetration of bond insurance in the municipal market. And we at Assured Guarantee are very proud to report that the penetration of insurance in the municipal market is actually up to a little bit over 7%. It's good news for us. It's actually twice of where it was almost a year ago, and a great increase over 2013 when it was actually just under 3%. I want to put this in perspective, and actually to answer the question, are munis rich? Not to answer the question, but to give you some questions to think about on the topic, which is that back pre-financial crisis, bond insurance was provided by actually nearly 9 providers. About 57% at its peak of the market was insured. In certain sectors, like airports at one point, 90% of the debt insured by airports was taking insurance. Now insurance is down to 7.5%. We consider that a good penetration rate. Our expectation actually long term is that at most bond insurance will be 15, maybe 20% of the market, to the extent that we see some rise in interest rates that provides a little bit more pricing opportunity for us, because right now in a very tight spread environment, there's not a lot of room in there in order for us to gain a premium that's adequate for our purposes, and investors aren't as willing to give up yield. But a couple of things to kind of consider in that point, and one of the reasons why the expectation for insurance is such is that today we're rated in the AA category by S&P, AA plus by Kroll. We our target market is the BBB market, which is actually about 40% of the municipal market. And so right away, the size of the market that is now available to us is considerably smaller than the market that was available pre-financial crisis, when the insurers were rated AAA, and before the shifts that the ratings agencies had undertaken during the last 10 years in terms of what used to be, it's the old, it's the 50 is the new 40 or 70 is the new 60. Well, AA is the old is the new A, because a lot of the ratings agencies had undertaken sort of a parallel shift. So our zone of possibility for insurance is actually a lot smaller than it used to be. One of the things that bond insurance does is that it provides liquidity to the market. Right? What would happen, and one of the reasons why so much of the market was insured pre-financial crisis, is that the institutional buyers didn't have the credit staff. They relied on the AAA ratings, but they also relied on the financial strength of the bond insurance companies. And so one of the things that it did was it provided a level of liquidity to the market. You had a lot of trading in insured bonds. And one of the things that's happening today is that, and I think one of the questions that I ask is that, I can't answer the question, are munis rich or cheap, but I think one of the things to think about if you're trying to answer that question for yourself going forward is, looking out in the market into the future, what's going to provide the liquidity that bond insurance has historically provided. I think one of the other things that's happened in the municipal market, going back to my comment about the shift in the ratings, is that parallel shift. I think that the loss of gradation in the ratings with the AA is the new A kind of actions by the ratings agencies is that it's a lot more difficult for investors to discern those fine gradations in credit quality and to identify some of the things that give the market, that had historically given the market some liquidity. And so I think I'm not here with answers. I'm actually here with some more questions. A couple of other things I wanted to just point out. Actually, yes, sorry, I'll go forward a little bit. Just, again, in talking about our ratings, assured guarantee is now rated AA flat by S&P. We have a stable outlook. Actually, a year ago, we were upgraded by S&P from AA minus to the AA flat, and I think that was one action. One of the reasons why the insurance penetration is up is the fact that, the market had gone through the series of downgrades from the bond insurers, and I think that change in tide was one of the things that investors basically finally saw, that there might be some stability in the ratings. And so I think one of the reasons why market penetration is up is because of that change in perception in the market of bond insurance. But the other thing to kind of bear in mind is that as the market and our insurance penetration at 7.5%. Right now, assured guarantee insures about 300. Our outstanding portfolio is about $344 billion of municipals. Out of a 3.7 trillion market, that's about 10% of the market, and that's one of the things that actually gives our insured bonds the liquidity. It's actually a fairly large portion of the market today. And if you add in the other bond insurers, the legacy book that National Public Finance Guarantee has, there's some liquidity there. But as the market continues to shrink, the insured market continues to shrink, I think some of the liquidity associated with the insured bonds is actually going to decline. What it does, though, is it actually helps to deleverage our book. And so at the end of the day, one of the things that I also wanted to point out is that, today we're rated AA. If you look back at our financial metrics in 2007, when we were rated AAA, our financial metrics haven't changed. We actually still have $12 billion in claims-paying resources, over $12 billion in claims-paying resources. We generate over $400 million a year in interest income without breathing, right, on our $11 billion investment portfolio. And there's about $400 million in assured guarantee bonds that are actually trading daily in the market. And so that's the liquidity that we're providing. We expect to continue to provide that. But again, I'm here with a bunch of questions. I'm not here with any answers. But I think these are just some things to think about as you're trying to answer the question, or questions, are munis rich or cheap? Thank you.
Well, thank you, Mary. Now let's move on to, one of the things I really enjoy about interviewing people in the market is that I always felt that when you called up a big buyer, you'd get a straight answer. Because they're one of the few people in the market who will, generally speaking, give you a very straight talk. So Sean Carney, that's you. I know you don't. You probably don't like bond insurance, so maybe we should separate you and Mary there.
No, I wouldn't say that's
We're all
true.
friends.
Absolutely. Well, first, let me say thank you for the opportunity. As I looked over today's, not only the speaking list, but also the audience, it's a great privilege to be here. I've learned from many of you, either by picking your brain or working with you or for you, and this is a fantastic opportunity. So let me begin by saying thank you. What I wanted to try and do was answer the question: are munis rich or cheap? And I have a lot of questions as well, but I'll give it my best. I think the place to begin is to kind of frame the discussion. When going and speaking to clients, I always want to know, kind of what their background is and what it is they're looking for out of munis. Different owners of the asset class own it for a different reason. What I've done here on the left-hand side is just chart some of the Fed flow of funds data. We know that the muni market is largely owned by retail. That factually it is about 70% owned by retail when you take the household sector and add in funds. And there are a lot of characteristics of the muni market that are set by this. The seasonality of the muni market is very unique, and I believe it's because the amount of retail ownership within the market. The underlying fundamentals of the market are changing with who's adding and subtracting assets. So banks are buying in the face of greater regulation, even as munis have been left off of the high quality liquid asset test for now. Broker-dealers have been subtracting from their inventory. They currently hold $19 billion as opposed to the $40 billion that they held pre-crisis. This has meaningful impacts for both liquidity and volatility inside the muni market. Some of the others that I point that I think are important and are growing, both the ETF space, those that want to own the muni market or own the beta of the muni market and not pick individual securities, as well as what I have listed up there is rest of world. So this is the buyer that we introduced to the market in April of 2009 through December of 2010 via the Build America Bond program. This brought in the foreign buyer, and we noticed that that foreign buyer has stuck around and still has great interest in the market, as Jason mentioned at the outset. On the right-hand side, we highlight the tax exemption because different owners of the asset class own it for different reasons, whether it be the stability of the asset class, the high credit quality nature. Different characteristics mean different things to different people, but at the end of the day, the tax exemption is very powerful today. So we chart out what we call the high grade, or better known as MMD scale of the market, and then the taxable equivalent yield at the top tax bracket. And it's quite impressive. If you're a long buyer, that 3% long bond muni ticks up to nearly 6%. If you're an intermediate buyer of a 2% 10-year bond, that ticks up to about 3 3/4. So we think that in a world of low interest rates for longer, which we'll speak about in a moment, that these are pretty compelling yields on a before and after tax basis. So when asking the question of are munis rich or cheap, it depends who's asking. If you're a buyer of fixed income, and you're comparing munis to treasuries, munis continue to be a rather okay investment in the sense that the treasury market has traded in a very choppy range throughout the year. We'll call it 2 to 2.5. There's been a decent amount of anxiety in the treasury market, both from global and domestic activity, as well as a market that is trying to time a Fed's liftoff. The Fed has gone out of their way to be extremely transparent, but at the same time seems to have created a massive amount of confusion. Markets are having a difficult time with this, and you see it in the Treasury market. Now, on the right-hand side, if you want to compare munis to corporates, it's a completely different story. Corporate IG has issued about $925 billion year to date. That's a massive amount of issuance, and the market has had to back up in yield and spread to accept this issuance. So when you take 10-year munis and compare them to 10-year corporates, not as attractive on a relative value basis. We know the difference in credit quality and volatility within the muni market versus the corporate market, but on a natural relative value basis, that's the conclusion. One of the great transitions of the muni market since the crisis has been the market transitioning from a rates market to a credit market. We know that very well. But just like we were never truly a 100% rates market, we'll never truly be a 100% credit market, and we do rely on where interest rates are going. I put this chart on the left to show that 10-year JGBs are trading at 30 basis points. 10-year German bonds are trading at 60 basis points. So it makes all the sense that 10-year treasuries at a 210 prior to walking in here still have relative value. A 210 is not something that somebody jumps at and thinks of as high yield by any means, but on a relative value basis, there is still attractiveness in a 2% or 210 10-year. On the right-hand side, we just try to take a quick snapshot at what the Fed has told us they're looking at. The Fed is data dependent, we know that, so we need to watch the data that they're watching. But in today's environment, we look at a Fed 5-year forward, so where will inflation be theoretically in 5 years? And this morning, that's at 177. We're not in an environment where inflation is getting away, so the want and the need for fixed income, especially after days like yesterday when you watch equities fall the way they did, is not a very hard sell in today's market with very low inflation and forward inflation expectations. This is something that I wanted to look at. One of the things that we often talk about is a lower rate environment for longer. The previous slide talked about from the inflation standpoint. This is something we put together to talk to clients about. We're often hear from retail that the biggest fear is rising rates. So we took a chart and took 10-year treasuries and 10-year munis back to 1928, and we stripped out the key earning and spending years of the baby boomer generation. So that greatest, most populous generation that moved through a single economy at one time, had the ability to push up prices, and we understand the effects of that. When you take the average 10-year treasury, it is about a 5.10. When you strip out those key earning and spending years, that average falls to 3.10. So when we talk to clients and their fear is that rates are going to rise, we ask them to speak to us about where they see inflation coming from in an aging demographic with millennials that are strapped with greater amounts of debt than past generations, and ask, is your fear that interest rates are going to go to 5%, or that in all reality interest rates move off of 2% and move to and possibly above 3%? That's not our base case in the near term by any means, but it brings the conversation home and makes people more comfortable about our longer term outlook on interest rates. It's impossible to have a muni conversation rich and cheap and not talk about the fundamentals that underlie the muni market. So just two charts here that show state and local quarterly revenue improvement. We recently got more data from when I put this together. We got the Census Bureau data last week, which shows fantastic, I believe 6.9% year over year second quarter growth in state and local government. So 16 out of 18 quarters of positive revenue growth. Yes, it has been a slow growth period coming out of the Great Recession. We understand that, but at the same time, economies don't get themselves in a lot of trouble when they're growing at 1.5–2% because they're not levered like they were pre-crisis. On the right-hand side, we talk about just the reliability of property tax revenues on the muni market and just how important that is for the revenue sector, and again, on the improve. One of the questions that I often get on the road is about high yield. Is there an opportunity in municipal high yield? And this is a question that we could easily have spent the entire 15 minutes on. And please remember, at the outset we spoke about retail owning 70% of this market. 60% of the income derived from municipal bonds is harvested by individuals age 65 and older. And 50% of that income comes from those that file making less than $200,000. So as Jason mentioned at the outset, in the way that the business was portrayed to me when I entered, that it was an asset class for the rich, for the one percenters, that has changed drastically. again, back to the question at stake here about high yield. High yield is actually just higher yield. And on the left-hand side, what I wanted to show was the often quoted 7% muni high yield market. When you strip out Puerto Rico and tobacco, that yield falls to about 4.5. So that's more yield than the general market at 220. But we have to understand the risks that we're taking when we take on large positions in either Puerto Rico or tobacco. Puerto Rico and tobacco make up 43% of the high yield market. I think that's pretty telling of the high yield market in general. It obviously has a bit less transparency, more volatility, and a little bit less liquidity at the time when you need it. Is there room for it in a portfolio? Absolutely, we believe that there is, but it's very important to know what you own. Again, on a relative value basis, when you compare it to high yield corporates, not very attractive, but when you're adding it to a traditional muni portfolio, it does. We spoke a bit about, and it will be covered today, I'm sure very well, Puerto Rico, but another sector inside the high yield market is tobacco bonds. About 25% of that market is owned by non-traditional crossover buyers that really understand the cash mechanisms behind an MSA payment, but at the same time, there are near-term and longer-term outlooks for a tobacco sector. So the longer-term outlook for a sector like that is rather dull when you consider that less and less Americans are smoking. You have greater taxes that will be achieved on smoking and a vice tax, as well as the fact that there is more competition from e-cigarettes. The short term has been pretty fantastic for cigarettes, though. If you look at oil prices falling, gas prices falling at the pump, this has led to a greater amount of cigarettes being purchased at a point of contact, i.e. gas stations, convenience stores. So the consumption of cigarettes in the near term, better than in the long term. There is opportunity in high yield, but again, think of it more as higher yield with more volatility and less liquidity at a time when you may need it. I'll yield the rest of my time there, Joe.
Okay.
Thank you.
Sean, I love that. I think I'm going to use your phrase as the sort of subtitle of my publication.
It's yours.
It'll be called Municipal Bonds, a rather okay investment. I love it. Kathleen, you can take the floor.
Thank you, and good morning, everyone. I'm happy to be here. I do have, some of my comments are going to be similar to what Sean said, but I do have a little bit of a different angle. I think that was John's presentation up there. So anyway, are munis rich or cheap? I didn't really want to cop out on that question either, but if I hit this button here, you'll see my answer. It depends. So I don't have a yes or no answer there, but it depends on a variety of factors, including an investor's individual investment objectives. I thought I'd go through three things that could be helpful in helping you decide whether munis are rich or cheap. Number one, I'm going to go through just the traditional metric that investors usually look at to see if munis are rich and cheap, and we'll talk about what's right with that, what's wrong with that. Sean went through a little bit of that. Second, I want to go through the drivers, what's driving muni yields right now, and then finally what our outlook is for the municipal bond market going forward. And all put together, I think that could help individuals decide whether you think munis are rich or cheap. The first slide here I have is the municipal to treasury yield ratio. This is the ratio that we look at in the market to determine if munis are rich or cheap. What I'm showing here is just simply that at the 10-year and 30-year maturity points, the ratio right now is hovering around the 5-year average. Now, the 5-year average is the post-financial crisis era. So one could argue that those ratios are certainly elevated versus the pre-financial crisis era. We do think that the ratios do have room to move down further from where they are right now. Maybe we can talk with Sean about that later, but not down to those levels where they were pre-crisis. And a lot of that has to do with the abundance of bond insurance pre-crisis, I think, did serve to commoditize the market somewhat, and that's why ratios were so low at that time. Moving on to the factors that are driving muni yields right now. I mean, munis, the okay investment, as Joe just mentioned, the returns year to date are up about 1.6%. and on a relative basis, that is attractive versus the other fixed income sectors. The four things that we attribute to the positive performance thus far this year is, one, Federal Reserve. That is the name of the report that we just put out, our Municipal Market Guide. I titled it Federal Reserve. The central bank's reluctance to raise short-term interest rates at this last meeting ended up being supportive to municipals. Subdued inflation has also been supportive to municipals recently. The flight to safety, that's something else that the municipal bond market did benefit from. As risk assets sold off in August, we saw, flight to quality, supporting Treasury securities, and munis did benefit from that as well. And finally, the market technicals. The market technicals over the past few months have been favorable. That is consistent with historical trends. Usually in the summertime, we do see that redemptions tend to outstrip supply, and that ends up lending some support to prices. On the flip side, the headwinds are about to price volatility. I mean, the market is more volatile than it has been in the past. Mutual fund flows, that is something that we've been watching. It is something that we keep tabs on because, as Sean mentioned earlier, mutual funds do own quite a bit of municipal bonds. They probably own about 20% of the market. So we always want to watch that to see if there could potentially be some issues there that could be disruptive to the overall market. We're not seeing that as of yet. And finally, pockets of credit risk, which I believe the next panel is going to talk about in more detail. Certainly Puerto Rico, the city of Chicago, Chicago Board of Ed, Kentucky, New Jersey, and maybe Pennsylvania make that list. Moving on to the technicals. As I mentioned, Munis is a very technically driven market, so we follow this very, very closely to see if we think Munis are rich or cheap. Supply has been running ahead of last year's levels. That was probably what made Munis cheaper earlier in the year. And as I said, the technicals have just been positive over the past few months, which was supportive to Munis. On this next slide, which I do get some of this data from Bloomberg, this slide shows net supply. So this is helpful in determining, which months we think the technicals are favorable and which months the technicals are not favorable. And what you can see here is what I just mentioned, that in the past few months, the technicals were supportive to the muni market. We do think that that's set to shift here in the fourth quarter. And if anything, if muni yields pull back as a impact from these weakened technicals, we do think that could represent a buying opportunity. On the next slide here, I show the pace of muni mutual funds going back to the Meredith Whitney era, just to give you a sense of the magnitude of the outflows that we've seen in recent months. As I said, earlier this year, we were concerned that maybe these outflows could accelerate and perhaps get to that taper tantrum level back in 2013. That didn't happen, thank goodness. So you can see that we've had 5 consecutive months of outflows this year, but the pace has been significantly lower than what we saw in 2013, as well as during the Meredith Whitney crisis. And I believe if you look at weekly data, we did see some inflows just last week. So not overly disruptive to the market, but something that we follow because it does have potential to disrupt the market. Next, I have some statistics here that show you how muni defaults at a much lesser rate than corporates. This study is from S&P, and it shows that, in fact, BBB rated munis have a much lower default rate than BBB corporates, and that's over a 10-year period. Now I have a few slides here that I thought could be interesting to show people what's happened during the last rate hike cycles. We get this question all the time at UBS, so I've prepared these slides, and it serves to educate investors on the last 2 periods, the 1994-1995 cycle versus the 04-06 cycle. 1994-1995, long-dated securities had the worst results, and short-dated had the best. By contrast, in 04, the 04-06 cycle, long-dated munis turned in the best performance, short-dated had the lowest performance. We attribute those disparate results really to 2 primary factors. In 1994-1995, if people remember, the the Fed increased rates at a very fast pace, and that disrupted the market. You also had Orange County, California filing for bankruptcy in that year, which also served to depress the long-dated area of the market the most. 2004, 2006 was totally different. You had a longer time period of rate hikes. It was a gradual rate hike cycle, and as you can see, long-dated munis performed quite well. We do think that this cycle coming up would be more like 2004, 2006, and we're not looking for a repeat of 1994, 1995. I also have some charts here that just show how munis perform during periods of rate volatility. I have 3 periods here. I show the most recent period earlier this year when German bonds started selling off. We had rate volatility occurring across the broad financial markets, spilled over to munis. Then I also show the taper tantrum back in 2013, as well as the Meredith Whitney phase there. And I look to see what parts of the curve performed best and worst during these periods. And what you see in all 3 is that initially, long-dated munis turn in the worst performance. But if I was to expand these graphs, what you'll see is long-dated bonds tend to reverse course and perform much better over longer periods of time. So this is something that we like to show our clients, that often we have clients that tend to sell at the worst times and then try to get in also at the worst times. So hopefully this can educate some of our investors. And then finally, I have a chart here that just shows muni returns versus equities. I mean, this shows you, maybe if you're determining, how safe munis are versus equities, take a look at the return volatility over time. And what this shows is, like, since 1999, we did have 3 negative years for muni returns. If you look at equities, there were 5 negative years for equities, but at much more magnitude. And of course, that works in reverse. You've got a lot more upside with equities, a lot more downside with equities. But what we'd like to show people is that over long periods of time, municipal bonds tend to be much less volatile than returns seen in equities. And then finally, going forward, these are things that we're talking to our clients about. I mean, certainly, Federal Reserve takes center stage. Everybody's wondering, everybody's focused on, is it going to be October? Is it going to be December? Whether it is October or December, we don't think it's going to make a huge difference on the impact of municipal bond performance going forward. Near term, I am looking possibly for a pullback in yields based on weaker technicals, and if that does happen, I think it would be a good buying opportunity for investors. And the other point I have there is gradual rate hikes. We do think that this rate hike cycle is going to be gradual, more like 2004, 2006, not like 1994, 1995. And that should not have a profoundly negative impact on the municipal market in our view. Then the other point I have there is bear flattener. We do think that it's likely that short rates will increase more than long-term rates, and if that is the case, longer-dated munis should perform well. So we do think that investors are better served by being further out on the curve versus in short-dated securities right now. And then finally, the last point I have there, which hopefully could help you decide whether munis are rich or cheap, is we do think that munis hold strong value on an after-tax basis. We think, the tax reform efforts are unlikely to move forward until after the next presidential election. So that said, tax rates are very, very high. So if you run the after-tax yields on munis versus other asset classes, they are still very, very attractive.
Okay. Well, thank you, Kathleen. That's because municipal bonds are a rather okay investment.
I'm going to use that for next month's title.
John Musso. He has 45 slides here. We'll be begging for mercy by the end of it. Sir.
I do have a whole bunch more, but.
And I'm only going to use a few of them, so don't worry. Thanks for having me here today, and it is great to see a lot of familiar faces. And that's the one thing that makes the municipal bond market great are the people that are in it. At Cumberland, we really are a top-down, economics-driven firm, 30,000-foot view of the world and how we approach things, and it's no different with municipal bond management. So a few economic slides and then talk a little bit about the market. I'll run through this one first. First thing, we really look at different measures of unemployment, and concentrate often on U6, which is the larger measure of unemployment, which includes part-time workers, people looking for better jobs, et cetera. And we know that has been sticky coming down, but it has come down, and the gap between the regular unemployment rate and the higher measure, U6, has narrowed. It is still 200 basis points above normal. It was 300 basis points above normal. So it is moving in the right direction. It may be here for a while because we may be in a different type of economy. Certainly more underground economy, cash. So it's, there could be a new normal here, but it's certainly moving in the right direction. The labor participation rate, we look at this often. We know that it has been 2 steps back, 1 step forward for the last few years as the labor participation rate has come down. It is starting to show some signs of bottoming out. Where I'm going with this is that the fact that these are all signs in our eyes that the Fed maybe made a mistake by not moving, last couple weeks ago. Wrote a piece last week trying to incorporate some Yogi Berra-isms into the bond market, and one of them was, when you come to the fork in the road, take it. Well, we know the Fed did not take the fork. And, in our eyes, to help clear the short-term markets and to bring some stability to the banks, get the banks back in the game, the Fed probably should have gone forward here, and eventually they will. Unemployment has come down. Another reason why we think the Fed probably should have moved. This has been, almost a parabolic drop on the other side of what we saw. And again, moving in the right direction. Is it back to pre-recession levels yet? No, but it is moving in the right way. Maturity structure of the Fed's asset. This is the 3 levels of quantitative easing. And we see the red is long-dated assets that they have moved on their balance sheet and the last round of quantitative easing. And you can see the tapering right at the end as they've tapered. So the Fed is kind of where they want to be from that standpoint. And our view, because of this slide, is that the market shouldn't be worried and shouldn't have been worried then about the size of the Fed's balance sheet. We see how the deficit, some of this through sequestration, some of this through higher tax rates, it's not to zero, but it is getting closer to zero. And our contention is that whereas the Fed is not going to sell their balance sheet, that you could be in a position where the market wants the Fed to sell their balance sheet. So it goes back to the idea that the worries about the taper tantrum a few years ago were way overdone. And the fact is that even now, the Fed is totally in control of how they want to sell their balance sheet through a combination of rolling off and the duration of their balance sheet going lower. Kathleen had this slide up, and it is the same slide, but the remarkable part about this with the municipal bond flows, which caused so much consternation in 2010-11 with Meredith Whitney, and of course with the taper tantrum in 2013, is that the bond market, even though, as David mentioned, with long yields at 130% of treasuries or in that neighborhood, yes, it is very cheap. But on a nominal basis, the bond market, as we'll see, has really repaired itself since 2013, but without real participation from the bond funds. And that is one reason why, even if the Fed starts to raise rates, we don't think you see a massive outflow of bond funds again, because they haven't seen the inflows come back in. The place of the bond funds has been taken to a large extent by private investors, some of the banks, profitable insurance companies, et cetera. So from our standpoint, the fact that the bond funds seem to be less of a player in here is a good thing from the viewpoint of bond market stability, particularly in munis as you go forward. These are the crises that I have happened to live with in the 15 years I've been at Cumberland, and certainly since 2008. The interesting thing about not only the fallout post-Lehman, the Meredith Whitney moments, the tapering, is that we saw the evisceration of the muni market, again through bond fund selling, is that you had yields increasing at an increasing rate in all of them. And the only thing you know is that that is a bad market, but also unsustainable. And we see the recovery in all those. And we're at the point now where people have worried a little bit about the Fed rate hike, but this is nowhere near on the magnitude that we had in these other crises. A little bit on the credit side. This is Moody's rating changes on revenue bonds, upgrades and downgrades. And we can see on the revenue side, very well behaved. The downgrades have come down a lot. Upgrades have come up. It is certainly the directions that we want to see here. And I think it points to the fact, and we see this, of course, reflected in Puerto Rico and in Chicago, et cetera, is that bonds that have secure liens, revenue bonds that have secure liens, have moved to the forefront in terms of perception of credit quality versus a lot of general obligation bonds where as we've seen things run into trouble, people are just really an unsecured creditor if they really get into problems. Tax-backed, a little different when you get to some of the GO stuff. We can see that the downgrades have picked up a little bit and the upgrades where they have come up, it's a little different story. It's not quite as good as the revenue side. And this is reflected in our own bond management over the last 8 years, as we have certainly moved more towards revenue bonds, and particularly essential service revenue bonds, and less towards the GO debt. And that's been reflected in the crises we've seen, of course, in Puerto Rico, but also Detroit, Chicago, and a few other areas. This is one of the reasons why, and Kathleen had this as well, why we don't think it's going to be a problem when the Fed does begin rate hikes. This is the 04 to 06 period, and it's with the 10-year and 30-year bond. And the net of it is that by the time that you hiked Fed funds from 1% to where they ended at 5%, the 10-year Treasury bond was really only up by 85 to 90 basis points, and the 30-year Treasury up less than that. So it goes to Kathleen's point, also reflected in Munis, is in that time period, the part that underperformed was if you had gone and buried your head into the short-term end of the bond market, you really had very poor returns because you were basically faced with those rising rates, whereas in the longer end, you actually were paid to collect that coupon. And there was a great JP Morgan study that was out 2 years ago, and it looked at the broad bond market over the past 20 years, and it looked at how much of the total return of the bond market was from basically price change, and how much of the return over 20 years was from the coupon payments and the reinvestment of those coupon payments. And when I was asked the question about what I thought the answer was, I was pretty off. I thought maybe 75% was from the coupon payments and reinvestment, and maybe 25% was from the price. The answer was 99% was from coupon payments and reinvestment of coupon payments. So this is from basically 1993 to 2013. Now, my answer in there was just based on the fact that the 10-year Treasury 20 years before had been at 5, and in the fall of 13 it was at 3. But it told us two things, and it's reflected in what happened in 2004 to 06, is that if you're a total return bond manager, number one, it is very important if you're picking your points to enter the longer term part of the bond market. It's a big difference if you're entering the market at 5 and entering the market at 3, and even relative to inflation. But the other part of it was that even if you get to a point where you're saying, geez, we're really looking at possibly some decent rise in rates, is that to use the phrase, but bury your head in the sand, is really sentencing you to some very low returns, especially with a steep yield curve, and that you need some devotion, and as a portfolio manager, it's your job to decide how much, to the longer end of the bond market, precisely because of that aspect of the coupon payments providing the percentage of returns that they do over a longer term time period. Just a little bit on Fed and job formation. Essentially, our viewpoint is that the inflation is going to rise a little bit, but it'll probably stay low. We know that core CPI is now well above headline CPI, and that rates, once the Fed got to tapering rates are significantly lower than they were when they started tapering, which of course is totally upside down from what the market expectations were. I think all of us in this room can go back to 2013 and how much literature crossed our desks saying, are your clients prepared for higher interest rates? Well, we know that they got just the opposite. This is courtesy of our friends up at Municipal Market Advisors, and it's really the percentage to Treasury yields of the 5-year and 10-year and 30-year MMA ratios. And as we know, MMA uses a 5% coupon with a call feature, so the actual yield to maturities are a little higher. But if you account for that, really the long end of the muni market is trending at around 130% ratio to Treasuries. But even the 10-year is still trending around, over 100%. But what it tells us is that the longer end is the cheapest part of the bond market and has been for this year. And if you think about it, it's pretty clear. What did Kathleen showed about what we had in supply this year. And if you went through the first half of this year, we had about $220 billion of supply. 3/4 of that was for refundings. Some advanced refundings, but mostly current refundings. And when you think about the aspects of a current refunding, the people that are the issuers, they are very pretty much, not sensitive to what interest rates are. And the point is that if there's a 5 or 5.5 coupon with a current call on it, and you started this year call along muni at 3.5, somewhere in that range, is that they're impervious to whether they issue new bonds at 3.5, 3 5/8, 3 3/4, 4%. The only thing they can't do is not call the bond in, have interest rates rise, and then have somebody pointing the finger at them saying, why didn't you call those bonds in when you had a chance? So that was the onslaught of supply. And if you look at the bonds that are coming due over the next years, you're going to have some more supply next year of the same type, but it's going to be less. So our contention is that, boy, after you got through the first half of this year, you are probably going to be in an environment where supply will be down. Obviously, demand probably is a little higher from the volatility of the equity markets, but that you would not see the kind of, muni bulge that you saw in the first 6 months of this year. So we extended our durations accordingly. We get asked this question a lot, is when are interest rates going to start to rise on a secular basis? And the answer is, we don't know. Here's 50 years, and I think Sean made the great point about the baby boom generation going through and really pushing yields up. And we're a big subscriber to that theory, and in a lot of other work we do, we take that time period out as well during the Volcker years, because it does throw everything off so much in your analysis. But you spent basically 20 years with rising cycles of rates where each peak in a cycle was higher than the last peak and each trough was higher than the last trough. And the last 34 years was just the opposite. And we still don't know whether we've bottomed out or not. And if you look at some of the other detailed work that's out there that looks at financial crises like we had in 2009 or 1929 or the Nikkei in 1989 or some of the panics in the 1800s, in all of those cases, interest rates didn't bottom out till 10 to 12 years after these financial calamities happened. And you think about, why do financial calamities happen? It's the fact that they need to wring the excesses out of the markets at the time. And it takes a long time. Last thing, real GDP growth continues to kind of muck along, but it's positive. And headline versus core CPI, which you can say here is flipped upside down. I think we'll stop there and we'll take some questions.
Okay, thank you, John. All right, gang, this is the best part of the event, when you are invited to ask questions to the panelists. Okay, we have a microphone, so when you raise your hands. Otherwise, I'll start pulling bids from the chandeliers here, if that's what you want.
Good afternoon. I'm just curious about one thing. You talk about where the percentage owned by mutual funds, I think Kathleen had mentioned somewhere around 20% right now of munis. What was the peak number?
Let me think about that. The peak, on a percentage basis, you mean? You know, I think that number has been pretty stable over the past couple of years. Does anybody on the panel have a different view on that?
I don't have the exact
Yeah.
number, but I
think
think
it's
it
been-
it was probably somewhere in the, neighborhood of double that.
Yeah. I think that if you just
Yeah.
go back to say, 2007, 2008, I came to BlackRock as a trader on our separately managed account desk. At that time, our SMA business was about $8 billion, and today it sits at 24. And the reason for that, I'd like to believe it's because of good marketing and traveling, but it's not true. It's really because the retail investor wanted greater transparency and wanted to see the CUSIPs that they owned coming out of the crisis, and they've shifted their money there. The other transformation that's taken part in the mutual fund business is it's largely been known as a long duration, asset class, muni closed-end funds with long durations and open-end funds. But at the same time, a lot of money has moved into the intermediate space as there's been more and more of these go anywhere, do anything type of muni funds popping up, these strategic opportunity funds.
Any more questions out there?
I have a quick question. For the insured area, how much of your growth is expected to come from kind of secondary reverse inquiry insured as opposed to primary issuance of insured?
So our secondary desk probably contributes about, I want to say somewhere along the lines of, about 10% of our income annually. I mean, it varies in cycles. So at the end of last year, when spreads started to widen out, we probably did more business in the secondary than we actually did in the primary. So it depends. But I think one of the things that we do expect is that, depending upon, again, the questions of, rich or cheap, we do expect to see a little bit more activity coming from the secondary market.
I would add one thing to what Mary said there, is that the other part of that is, as you see some of the cities grapple with some of the pension issues, et cetera, especially if you're even in a slightly higher interest rate environment, I see the growth of insurance expanding, just because what it does is it mitigates your headline risk.
Thank you, John.
Just another question, and first off, thank you all for the content. It's fantastic. Dave and John, this is a great event, so thanks for putting it together. Question, circling back to the topic of are munis rich or cheap? Obviously they've been cheap. I agree with the fact that they've been cheap, but I feel like I'm a broken record saying that literally for years, since 2011 and the tax reform proposals and whatnot. What do you see the catalyst being that will turn that around? Maybe we don't go back to the long-term average of 85, 86% of treasuries on the 10-year, but where do you see the catalyst turning? So that would be the timing question, obviously next year being an election year and all the rhetoric already starting up. But do you think that would be a catalyst, or what would be a catalyst to bring us back down into more tame relative value ratios or more historic relative value ratios? And then, John, you just mentioned what I was going to go with, which was pensions and OPEB. What do you think the timing on that event or series of events plays into that relative value also as a possible overhang?
Well, I'll take a quick stab and then pass it down the line here. To the first point, and I didn't have this on my slide, and I wish I had, is in that time period of 04 to 06, when you saw long-term treasuries rise roughly 85 to 90 bips while Fed funds went up 400, is that the muni treasury ratio during that time went from 105, or almost 105, down to 85. So we know that higher interest rates by themselves are a catalyst for this when they rise for traditional reasons because the economy is doing better. And I don't see any reason this would change, because you only need 65 to 70 basis points to equivalent the taxable equivalent yield. So I think the fact is, if you get the Fed moving, you start to return to a period of normalcy, and we haven't had normalcy in over 7 years. So I do think that will be the catalyst. There's no question some of the cheapness comes from the concern, as you said, John, about OPEB and pensions. And I think you see it tackled. I mean, you've seen it tackled in Rhode Island, for example, with Gina Raimondo. Now, they have the benefit of the fact that their pensions are included by statute as opposed to contract law, so they've had more flexibility in that regards. But I think state by state, city by city, these things get tackled because they can't afford not to be tackled. So I think as that happens, that is also a driver.
John, I think I would just add on that, the markets really dislike uncertainty, and as you remove some of the uncertainty, whether it be from the Fed or just from Washington in general, it seems like every 2-3 years we have this dark cloud that kind of hangs over the market that some type of tax reform, whether comprehensive or at the fringes, is going to be done, and I think that kind of just overhangs the market. Once you get the Fed to remove some of the uncertainty in the market, again, you'll begin to see ratios possibly tick down. I mean, the truth is that, curves steepen and cheapen heading into Fed rate hiking cycles and then flatten post. And if we get that type of move, you'll see lower ratios, and the long end of the curve, because of the coupon and carry that John mentioned, is going to, again, in a world of low interest rates where we're at 1.6 in performance this year, that coupon and carry is going to be garnered pretty heavily.
Great, thank you.
Hi, George Buxton from Morgan Stanley. In terms of the IG and high yield market, since '07, you've had a doubling of issuance, and at the same time, you've had the dealers decreasing their inventories by 80%, down to 20%. In terms of the muni market, it's a question for all of you, really. What keeps you, in terms of the muni market, what keeps you awake at night? Are you concerned about something like that happening to your market, which is a lack of liquidity, lack of market makers for regulatory and other reasons?
I have an opinion. I'll start. What keeps me up at night is a teething 10-month-old, but what actually, I don't worry about it as much in the traditional credit market, because in traditional credit markets, demand creates supply. So you see a greater balance there. The one portion of the market that has kind of grown a bunch since the crisis and has kind of become the sweet spot of credit in the muni market is the A-rated space. That's gone from sub 10% of the market to greater than 30%. The broker-dealer community as well as investors have gotten a lot more comfortable with credit and have really made that portion of the market a little bit more liquid than it had been in the past. But I don't worry about a portion of the market from a credit standpoint, maybe more from a structure standpoint, but not as much from a credit standpoint, that we're going to all of a sudden get over our skis in credit in the muni market.
I would add, this is what keeps me up a little bit at night. And, you brought up the point about how many more dealers we used to have, and Joe can ascribe to this, and this is just a factor of being old, is that you can remember 30 years ago and having 3.5 to 4 pages, single space, both sides, of dealers that wanted to bid on your bonds and to show you offerings, and who were terrific and wanted to be on those bid lists. Now that's down to about 1.5 pages, and it's double spaced. And that's one issue. But the other issue is when you see in the new issue market what's going on with pricing, and I'm not going to name names, but you're seeing some firms essentially bid down the competition to rid the market of competition. There was a Salt River deal not too long ago that was done for about 45 cents. The point being is that what keeps me up at night is that you lose all the smaller dealers, people that do great jobs for you. They go out of business, there's a lot less of them, and you're left with just a few dealers, and then suddenly they're going to say, you know what, we really don't have a bid. And they're going to control all the spread in the market. That's what keeps me up at night. Barry? Or you want to answer that?
Joe, question, following up on the liquidity question, it seems with the proliferation of SMAs, where you're going to have a list of eligible credits, are we going to turn into a market that has liquidity haves and liquidity have-nots?
Do you mean from an issuer standpoint?
I think in the secondary market where... In the secondary market where you have names that are on approved lists at various SMA shops and fiduciary shops, and out of the 60,000 issuers, most of those issuers aren't going to be subject to ongoing regular credit worthiness. So are we going to turn into a bifurcated market where there's a deep bid for some names and a very shallow bid for most names?
I'll take one stab, is I think if you maintain the dealers community and don't shrink it a heck of a lot more, so you're covered by the Spokane, Washington dealer, the Kansas City dealer, et cetera, I don't think you'll have that. We know that in our shop, we developed a credit scoring system model a few years ago, and the reason for it was simple. It was on the fact, as Mary said, the amount of insurance went down from 60% to 6%, and from 10 insurance companies to essentially 2. And the fact is that we know that the larger issuers get rated regularly. That doesn't make the fire district in Rhode Island a bad credit. It just makes it a non-followed credit. So we're not so doctrinaire that we have an approved list and a non-approved list from a credit standpoint, but we're going to err on the side of the more liquid names, and I think what you end up doing is that you start looking at, okay, we have a New England client, maybe we'll include the Rhode Island Fire District. There's probably no need to include it in the Oklahoma client.
I think your question is very A, timely, and B, spot on. This is something the market's wrestling with right now. You use the word bifurcated. I actually think there's a possibility the market begins to trifurcate. And what you'll have is you'll have the haves, you'll have the have-nots, and you'll have the middle ground. The haves, so the states that you're very, very comfortable with, the issuers you're very comfortable with, you'll own the lower rated credits within those states and localities. The have-nots will be flipped on their head, as most of them are going to be challenged by pension and OPEB liabilities that are greater than what they have. You're going to want to own bonds, like John mentioned, that have a direct revenue stream. That statutory lien is going to become very important. And then you'll have this middle of the market where you have the credits that come quite often. They've been reviewed by the credit rated agencies. You have an opinion on them. You can find the liquidity by going into Bloomberg and looking at the trading history. But I can begin to see the market really separate the haves and the have-nots and also leaving a middle ground. Yeah.
I mean, that's the one area where actually you see insurance become very active, an active part of the market. Our average deal size for insurance is about 15 million. I mean, and actually the BQ market has been a very active user of insurance. And actually, if you look at, going back to my original comments about that ABBB portion of the market, with it's about 25 to 30% of that is taking insurance on a par basis, but actually close to 50% of those transactions, again, that small issue market, is actually where insurance is being used right now, and I think that's what's providing the liquidity. Our surveillance staff on our public finance book is actually bigger than our new business staff right now. We have 30 people who are dedicated to surveilling, so our insurance actually has that, kind of continuous review on the debt that we insure regardless of the size of the transaction, because we do have the entire piece of it.
Okay, well, I think with that, we'll wrap it up, gang. And I'd like to invite you all to applaud this wonderful gathering here. And I guess invite David back up to introduce our next group.